Good morning, everyone, and welcome to our DAT IQ weekly market update. This is our update for December 7th, 2021. I'm Ken Adamo, Chief of Analytics, joined as always by Ned Damon, Principal Data Scientist, Dean Croak, Principal Industry Analyst, and we have a special guest, Ina Mayoub, who is our FMIC, Freight Market Intelligence Principal. Good morning, guys.
Good morning.
Had a lot of principals here today. I just realized that. Holy cow.
Right.
I need to step up my game. I need to be Chief Principal Data Science Man. Analytics. Something. I need new business cards.
Right.
Maybe Santa will drop them in the stocking. Who knows?
Yeah. I need to get some.
How's it going? We got some. I think Enon missed the memo, probably because we're terrible at communications internally at DAT, but there's Ugly Sweater Part 1 here. What's yours look like, Dean? I can't see. I see trucker. What's the bottom?
Just a picture of a big old truck, so nothing outrageous.
Nice. Does it light up, or is it pretty low budget?
I haven't installed the LEDs yet.
You haven't installed the LEDs.
They're stuck in a container off Los Angeles.
Nice. Timely. Yeah. Ned, what do you got? A skull there?
Skull and crossbones. It has a whole bunch of light up. Oh yeah, no, okay, they're coming through. It has. I
knew yours lit up from last year.
Yeah.
Nice. And mine, of course, is a Pittsburgh one that fit really well pre-COVID, and now is looking a little tight, but we'll hopefully work that down, over the next couple months. Well, hey, so we're here every week talking about freight markets. We're going to try to wind down the year with some special guests, and I think we're scheduling a Nostradamus episode over the next couple of weeks. We'll have Chris Kaplis on, going to do some projections. We're actually recording a Freight Vine podcast, most of us later today, which will be released. We just try to wrap up the year with some general insight and commentary on looking behind and looking ahead. But with that, I'm going to hop into the key points of the week to get us moving, because we do have a lot to cover this week. All right. So spot rates drop. That week after Thanksgiving, things just sort of typically pull back a tiny bit, but up considerably year over year, 13%. Contract rates flat, still up 11% year over year. That's pushing up against 45 cents a mile. So dry van loads up a bit. And again, I think week over week, you're looking at a diminished Thanksgiving week where you lost Thursday, Friday. Reefer volumes down. Again, I think that would be expected when you have just kind of some crashing back after the peak. Domestic produce season in Florida. Dean's going to have to cover more of that. That's a bit out of my wheelhouse. And then again, I saw the headline this morning and yesterday evening, 96 vessels in queue outside of, what do they call that, San Pedro Bay. Average wait time 21 days, up from 18 vessels last year. That's nuts. So with that, I'm going to turn it over to Dean to walk us through our full update for the week. Dean?
Yeah, thanks, Ken. Starting off with our load board activity in the dry van sector, as Ken mentioned, loads bounced back last week, about the opposite to the reefer sector, so seasonally on track with what we'd normally expect. Carriers returned to the market. There was a 32% week-over-week increase in equipment posts. I don't think as many carriers came back to the market as we would have normally expected, so the load-to-truck ratio moved up from 4.79 to 7.92. That's about a 65% week-over-week increase in that particular number. In the refrigerated sector, a lot of demand before Thanksgiving as we'd normally expect, but similar to the dry van sector, reefer carriers also came back to the market, but not as many came back as the dry van sector for a variety of reasons. The load-to-truck ratio increased the most last week, up 50% from 9.34 to 14.03. And in the flatbed sector, the number of loads moved on our 78 busiest lanes dropped again last week, down 7%. It's down 9% week over week the week prior. So there's a steady downward trend, even though recent hot weather has created a little bit more activity than we'd normally see at the start of December. Flatbed equipment posts are almost back to pre-Thanksgiving levels, increased 50% last week. So the load-to-truck ratio moved up to 48.45. Taking a look at our market condition index, Ken touched on some of the port congestions. It's worth reiterating some of the key points. There's been a significant change in how they track port congestion. You will have read in a lot of the media outlets, they've essentially moved a lot of the vessels out of sight, out of mind due to safety because of the pipeline damage and just safety in general, but also pollution concerns with all of those vessels sitting idling right off the coast. So they've made a new classification line 40 miles out, and also asked a lot of the vessels leaving Asia to slow steam to take their time getting there. So it's created the illusion that there's fewer vessels, but according to Kip Loudon at the Marine Exchange, there's 96 vessels waiting to unload as of yesterday. That's 40 inside the 40-mile mark. 40 miles is a long way off San Pedro Bay, and there's 56 outside the 40-mile mark. The average wait time's 28 days. What we've seen, though, and I think this is an important point, is we've seen as average wait time increases and congestion increases, we're seeing a lot more volume move on some of the intermodal lanes as inland port congestion, continues to be a major choke point in the supply chain. Back in February, we only had 40 vessels waiting to unload, and we thought that was a big deal then. But since February, dry van spot rates on the high volume intermodal lane from Los Angeles to Chicago has moved up 73%, or about $1.44 a mile higher. This week, spot rates for loads on the 2,000-mile haul to Chicago out of Los Angeles are averaging $3.41 a mile. That's excluding fuel. That's 70 cents a mile higher than this time last year when Asian imports began to surge. Truckload volumes on that lane are up 155% year over year. A lot of that volume moves to warehouse markets like Stockton and Phoenix. Los Angeles to Phoenix spot rates hit a new high this week at $5 per mile. That's up over $1 a mile compared to this time last year. Having a look at the market condition index for refrigerated, one of the more fascinating stories this time of the year is how a lot of the large produce growers of lettuce in the country move their entire operations south from the Salinas Valley just south of San Francisco and transport their entire salad production plant about 550 miles south to Yuma, Arizona. In the last 10 days, Church Brothers Farms moved their entire production plant on 60 flatbed carriers, flatbed trucks, all the way to Yuma, Arizona. They had it up and operational within 72 hours from breakdown to production. Quite an amazing logistical feat. That's why we call the Yuma, Arizona area the winter salad bowl. About 90% of our leafy greens start to come out of this region during winter. For produce carriers, this marks the shift in produce regions for consistent loadings, that is, to warmer freight markets in southern latitudes. Some of the markets start to come online this time of the year, including Florida and southern Arizona, southern California. Peak production months in Yuma, Arizona, we're starting to see volumes increase. They've got 9 processing and 23 cooling plants. They pump out about 400 truckloads per day. It's a fairly decent deadhead from Los Angeles and San Diego and even Phoenix. Rates are about 25 cents a mile higher in Los Angeles right now compared to outbound Yuma, Arizona. I think brokers are going to have a tough time trying to entice carriers to move further south, deadheading, unless there's a much higher spot rate coming out of that region. Spot rates are already up about 5 cents a mile in the last 3 weeks. Yuma to Dallas up 57 cents a mile since October. Yuma to Seattle, Yuma, Arizona are up by about the same amount compared to this time last year, averaging about $3.50 a mile excluding fuel. Loads to Hunts Point, New York, that's another major destination for leafy greens. Spot rates are up 35 cents a mile year over year, currently averaging $3.45. Having a look at our flatbed market, loads moved in our DAT flatbed network are down about 15% since mid-November. It's unseasonably warm, so there's been a lot of construction activity that's kept things moving. Weekly load volumes and spot rates are down, though. They're down on 3 times as many lanes as they are up. Some markets are reporting tighter capacity, as they always do, including the Pacific Northwest, Seattle, Portland, Medford. A lot of softwood pine, Christmas trees come from that area. Seattle flatbed spot rates are up 20 cents a mile in the last week. Average outbound rate from Seattle is 3.01 miles per mile. Loads from Seattle to Los Angeles, another big market for Christmas trees, are averaging $2.30 a mile this week. Further south in Portland, loads to Los Angeles are paying $2.42 a mile. That's around 20 cents a mile higher than this time last year. Wrapping up with our year-over-year look at spot rates. Following the spike in spot rates right before Thanksgiving, capacity eased ever so slightly in dry van, dropping 1 cent per mile to $2.60, excluding fuel. There's a lot more activity in the spot market this time of the year, so spot rates are a little bit higher. Capacity is tighter. Rates are about 13% higher than the week after Thanksgiving last year, when they were around 226 per mile. In the refrigerated sector, capacity eased a little bit more than it did in the dry van sector. Rates dropped 5 cents a mile to a national average of 2.99, still 18% or 54 cents a mile higher than this time last year, and almost $1 a mile higher than the first full shipping week after Thanksgiving in 2018. And wrapping up with our flatbed market year-over-year look at spot rates, last week's national average spot rate for flatbed ended where it started, flat at $2.57 a mile. That's 36 cents a mile higher than this time last year and about 50 cents a mile higher than this time in 2018. So that's it for this week's market update. Remember, if you'd like to find out more about what's happening in the produce market in particular and read more about the big logistics effort moving the salad production plants to Yuma, Arizona, go to dat.com/market update and download our weekly market update report. That's it for my update. Over to you, Ned, for the short-term forecasts.
Howdy, everybody. Just a quick note. After my short-term forecast, we're going to have Inam do some presentations about data coming in from Benchmark Analytics, also known as FMIC, on contract rates and LTL information. So there is extra time for you to get your questions in, but we're going to have a shorter question period after the IQ question of the week. So please do try and get them in advance so that we can make sure that we answer them as best we can. With that, we're going to begin talking about, and by we, I mean I, are going to begin talking about the forecast short term. Here we're looking at the dry van forecast. In blue, you can see the market rates observed by DAT, and then off to the right, you can see our forecast. In green is our ratecast forecast, which is our flagship model, which is expecting rates to maintain their current level up through about right before Christmas, and then a spike as we head into the Christmas season. In contrast, our short-term model in red is expecting things more or less steady as she goes up and to the right, gaining about 7 cents over that same period. In gold and silver, we have our two blended forecasts, which are mixtures of the two forecasts in different amounts and in different ways. And here they are leaning much more closely to the short-term forecast. However, I feel like the ratecast forecast does a much better job of capturing a lot of this kind of strong seasonal behavior. The short-term forecast is much more responsive to what's going on in short-term market trends, and I would tend to lean more towards the ratecast forecast in this circumstance. Moving forward to reefer, we can see once again in blue the market rates observed by DAT. Off to the right, you can see that there's a considerable amount of model divergence. In red, the short-term model is expecting a more or less linear trend, because that's what the short-term model likes very well, with a huge spike at Christmas, New Year's. This upward trend is going to be gaining about 6 cents over the next 35 days. In contrast, the ratecast forecast in green is expecting a seasonal drop and then rebound as we move into the holiday season. The drop is going to be about 5 cents over, and then a rebound that's going to take us up considerably. It looks about 10 cents or more from present levels. So if you are a reefer carrier, timing is everything. Our blended forecasts in gold and silver are leaning a little bit more towards the ratecast model in terms of a strong initial dip, but they lean more towards the short-term model in terms of the strength and duration of the holiday spike. Finally, moving into flatbed, here we see a correction from prior downward trends. You can see that there's broad model agreement. In blue is the market rates observed by DAT. And then off to the right, you can see our short-term and our ratecast model have broad agreement over the next 35 days, with our short-term model expecting a linear trend of a gain of about 8 cents, and our ratecast model expecting a slightly stronger gain early on and then giving back some of those gains as we move into the new year. And with that, we're going to pass the floor over to Inam to cover some shipper trends. Inam.
Very good. Thank you very much. Again, glad to be here. And my focus today would be primarily to talk from a shipper buy. So most of the audience here may be, selling to the shippers. So this is more of from a shipper buy perspective, how a shipper is seeing rates coming into them. So what you see here, and I'll explain the graph, how it is laid out. And then, in the future, I don't have to go down into this level of detail. What you see on the left side, the graph, the x-axis is time. So it's starting from 2016 to now. and the y-axis is what we call as the contract rate index. There's 4 lines. There's a blue, gray, green, and a red. The blue line is a representation of the routing guide. So this is the large proportion of a shipper's freight movement, right? So generally it is between 80 to 90% of their freight is moving at this level. So what you see in going back in 2016, 2017, it was relatively flat. Then you see in the middle of 2018, it peaked out, and then it came back down. We saw the 2019 slide, and then post pandemic, or the beginning of the pandemic, we saw things going back up, and we are still going back up, right? And the red line is the spot, how the shipper sees the spot market. And you see generally it is a precursor to the contract rates going up, which is the blue. So the red line is the spot, and you see the spot market started increasing or rising from the early part of 2017, and then slowly the blue line catches up, which is the rest of the contract rates in the shipper's routing guide. What's interesting here is also that the gray and the green line, which is quite interesting to the shippers because they have to continue to keep the contract rates current. So the gray line is the line, the rates that are being replaced. So when they go out to market to get a new rate on a contract basis, so you see the gray line is the rates that are falling off the routing guide, and the green line is the new rates coming in. So of course, when the gray line is lower than the green line, that means the rates are going up. And if it's the other way around, which is the gray line above the green line, then the rates are dropping. So you see that in the same fashion as how we would expect. When the spot rate's going up, you see the green line continue, following the same path, and then the gray line is below the green line, and so forth and so on. So let's focus on where we are today. So starting from 2020, middle of 2020, the green line is above the gray line. And the gap between the green and the gray line tells us, what kind of an increase or the rate of increase that the shipper is taking. So we'll focus on a different slide, primarily, what we call as the replacement rate is. So when a shipper goes out to the market, what kind of rate increases are they seeing for their contract rates? What you also see here is that the green line is not the same as the red line. So when the shippers, when the routing guide's failing, they're going to the spot market, but soon they are trying to get the rates back under control into a contract form, and therefore they are taking a rate increase, but not at the same level as the spot rates are. Let's look at the temp control side now, the next slide. And what you see there is the pattern is very similar. Dry van and temp control follow a very similar pattern in terms of overall freight trends for the shipper side. However, especially the temp control shows a little bit more seasonality. And again, it's very similar trend. But however, when we see just at the last few weeks, we see a quick increase. I'm assuming it is a very seasonal, and it will come back to normal very soon. But overall, it is very similar to dry van, and took a similar increase in the beginning of, I don't want to say post-pandemic, but it's since the big collapse when the shutdown took place. From there onwards, it's been a continuous increase, and the shippers are continuing to bring the leakage from the routing guide back to contract rates by continuing to do mini bids. Many of the shippers have already gone at least 2 rounds since the pandemic started, at least 2 rounds at a national level to get the rates to a sustainable level to make sure that their freight is getting delivered. Let's look at the next slide. which is the replacement rate. So this is what's quite important to the shippers, because the question always comes up that if I go to the market, what am I going to get now, right? Because they're nervous. They have to renew their contracts. Generally, the contracts are 1 to 2 years. It's more like 1 year nowadays. But the question is, what kind of increase am I going to take so that this can be budgeted and so forth? What we are seeing since Q3 2020, again, if you recall the previous slides, that's when the green line started going above the gray line. So you see the on a quarter-to-quarter basis what kind of increases the shippers have seen. So currently they are seeing same levels Q3, Q4 on the dry van side. However, on the temp control side, they are seeing a slightly higher increase. Again, the replacement rate shows the increasing rates the shippers are taking to their contract side of the rates. Okay. Finally, the next slide, we're focusing on overall how the routing guide is performing. So the blue area indicates the planned freight tenders to the carriers. So, and the red shows leakage going into the spot market. On dry van, we are still at the highest levels, even, as we all expect, it's worse than what we saw in 2018. However, what's important to show for a shipper's perspective is that it is not, it's not continuing to increase the bleed, right? It's under control. It's flattened out now, it's a big relief for the shippers. And if the market cools down, then you will see the blue area increasing. Temp control was not as bad as the dry van. At least the leakage was 3 to 4% better than the dry van was. However, seasonally for temp control, we are slightly increasing on the leakage side. Finally, just to on the LTL side, so LTL is a slightly different animal in the sense that for majority of the shippers, LTL is something that they bids are done every 2 to 3 years. It's not their majority of their business, but it is something that they need to have properly defined. What we are seeing on the LTL side is year over year about 11% increase at this point in time. The highest increase we saw was June to June, about 15%, a big swing. Again, on the LTL side, what we saw for the shippers is that as the truckload capacity tightened with the labor shortages, the shippers couldn't keep up with full trucks, and many pallets fell off the truck because of the truck couldn't completely filled, and therefore obviously most of those things are going to fall under LTL, and then the LTL demand picked up. The good thing about LTL, the overall network itself, is that it's a very efficient network. It's a hub and spoke network, and the facilities are already built. There is a clean route for them, so it's highly efficient. But the problem is when the capacity or the demand increases, they cannot increase. It's not like pulling a few trucks in and increasing the capacity. They have facilities built, and the overall network has to be properly defined. Therefore, the LTL, similar to like in a model, you cannot increase the capacity very quickly. So the LTL providers actually, they are working on increasing the capacity. I was actually ran into one of the people who are working for a large LTL company. They are saying that they are increasing like 10 terminals this year and another 10 or 15 terminals next year. Again, they are building their network, and also the LTL providers are benefiting from the growth of the e-commerce. They already have the networks set. Generally, LTL is not as nimble as truck, but they are definitely increasing in the nimbleness. The service levels are being increased to take over some of those the market share from the e-commerce side. Finally, just wrapping the whole thing up from a shipper strategy perspective, shippers did learn a significant lesson through this whole bigger swing that we have seen, even more than the overall since like 2010. So they are clearly looking at their networks in a very nimble way. What's the area, the part of the freight that they could allocate under dedicated, what should be general OTR contract, what should be spot, short haul, long haul shuttles. They're clearly trying to identify and take advantage of each of the opportunities that they could potentially have. Another big area of focus for the shipper, especially because almost 20% of their freight fell off the routing guide, they're trying to identify how they could plan to manage the freight that is falling off the routing guide, what we generally call as dynamic pricing, because that's when you're falling off the routing guide, the price is not set. Back in the day, we used to go into more of a backup matrix, also given by our incumbent carriers. It used to be always heavily ambiguous, because you don't see much of freight. So when you hit, it's a very high price. However, then we shifted to using some trusted brokers. So you have a few brokers that will handle all the things, all the freight that's falling off the routing guide. Now the index-based pricing, the API pricing, actually eating into that part of the business where the shipper can actually depend on capacity, but at a variable price. So that, especially in this pandemic time, this index-based pricing and the API pricing, the Ubers and the Convoys are clearly making an inroad into that area, where the shipper do, even on our daily life, we run into cases where we say, what, I know if I go to this place, I can get it, even though if I pay a higher price or whatever the market price is. And so that's the area that the most of the API price is the folks that are driving the API price is in playing. So overall, I think the shippers, the biggest thing to take away from the shippers' perspective is that it was a tough year. However, they continue to go to the market. They did a great job. They partnered very well. Those who had good partnership with carriers did very well. They further increased their relationships. And those who didn't have actually understood that having proper relationships with the carriers and their partners, I take them as partners, I think is extremely critical. With that, I'll turn it on to
all right. So we're going to be talking, because we received some listener questions in the midweek, about how the load-to-truck ratio is calculated and how the MCI metric differs. So Ken, with your leave, I'd like to go into a little bit of how these numbers are calculated.
I mean, I'm totally fine with you asking and answering the question yourself. It's pretty low lift for me. So let her rip.
All right. So the load-to-truck ratio was designed to be very, very simple. We count all the loads on the load board for a given equipment category, and we divide by the number of trucks posted on the load board for that category. There are some very small exclusions that I'm not going to go too deep into the weeds about, but basically, if you're posted a load or you've posted a truck, you are included in the load-to-truck ratio number. Now, what prompted this question was somebody noted quite rightly that there is sometimes a phenomena that we see where people will represent the same load or truck more than once on the load board. And this is one of the reasons for the development of the MCI metric. The MCI metric is designed to be more machine readable and easier to understand. So one of the things that you need to understand about the load to truck ratio is that what is a good load to truck ratio varies with time, and it varies heavily with location. So for example, in Little Rock, Arkansas versus say Boise, Idaho, a good load to truck ratio will be substantially different.
Or equipment type, right, Ned?
Pardon?
Or equipment type. Your average flatbed
yes.
load to truck ratio is in the 40s.
Yes, exactly. Like what is a good load to truck ratio varies an enormous amount with equipment type, all this kind of stuff. And that makes it very difficult for a machine or somebody who's not familiar with the market to understand. So if you're coming in and you are not familiar, if you're trying to do research about what lanes you're interested in expanding into, unless you watch it for a long time and get a sense of how that market is exactly behaving, You don't know whether looking at like hot market maps or another load to truck ratio product, whether a given load to truck ratio is good or not. So the MCI product does a couple of different things, this MCI metric. The first thing that it does is it deals with overposting. So if somebody posts the same load or truck more than once, it will turn down the volume on that. It won't eliminate it completely because it is a signal. It's generally, I like to call it a signal of desperation. If somebody's posting the same load over and over again, that is a real signal about how the market is behaving for that person. But turning down the volume helps to maintain linearity so that as people get more and more desperate, we still see kind of a nice linear trend in what the MCI metric does. It also corrects for different geographies so that things are comparable across time and across space. So that an MCI metric value of say 90 is always very, very hot, regardless of what market you're in, what time of year you're in, and what equipment category you're in. There's a couple of other things that it does that unfortunately we don't have a huge amount of time, but I am happy to talk about this in more detail. And I really hope that we did answer that listener question. Do you guys have anything before we turn over to quickie questions?
Nope.
Pretty comprehensive. Thank you.
Well done.
Yeah. All right. From Now and Later Moving LLC, is this a good market for box trucks now?
Yes.
Yep.
And so the reason why, at least from my perspective, is you're seeing overflow from truckload, so maybe partial truckload, and then you're also seeing, we had someone on from Pitt, Ohio. His name's escaping me. Help me out, Dean.
I'm still got loaded up with jet lag.
So we had someone on from Pitt, Ohio a few weeks ago, and they talked about basically turning away most volume requests, especially from anything but their largest customers. So those are things that can easily go into a 28-foot straight truck, presuming they have the tag axle, which is a whole different set of complications around paying the excise tax. So, I mean, long and short of it is yes. Sprinters, box trucks, anything that's legal and safe and up to most folks' standards, you're going to have a good time right now out there.
All right. We also have another wonderful question from Isa F. So only 18 to 20% of loads are in the spot market.
So it's probably pushing 25% now, right, Enam?
Yeah, I think it has slowed down. I think it was tracking that level, but yeah, currently it is somewhere around 20% is what we are seeing. From again, this is from a shipper's perspective, right? So shippers are continuing to go to the loads that are going to the spot market. They're continuing to push it back to the contracts, even though it's at a higher level, because the spot premium the shippers were paying were plus 30 to 35% when it falls off. And then when they push it back onto the contract side, they're at least raking half of it back. So they were taking 15-20%. So yes, currently they're sitting at around 20% in the spot market.
And that's 20% of for hire, right? That's not 20% of all truckloads. So that excludes private and dedicated and all that stuff.
Absolutely.
I think
which last estimate was roughly half. Go ahead, Dean. Sorry.
I think I looked at some of your data the other day. I think it was more like 12% on spot in pre-pandemic times. So it's pushing up on double the volume in spot since then.
Yeah, and I mean, I think the thing to pay attention to is we see the data, especially on the FMIC side, from a lot of big blue chip shippers. I think if you looked at, if you had like a crystal ball and could see data from all shippers, those smaller shippers right now are being hammered a little bit more in the spot market than, say, a giant cereal producer, right? I mean, so those are the things to think about of like, again, these big giant shippers can tend to impose their will a little bit more than someone making widgets or, shipping 3 or 4 rolls of steel a week. So just something to be mindful of.
Yeah, and they're a little bit more sophisticated too, right? They're using more systems and more processes.
Have any other questions queuing up?
No other thing, but I did have one more comment on that. Something that I think is important to talk about is that when you move from the shipper perspective to the broker carrier perspective, there's a whole lot of freight that is semi-contract where you have regularly occurring prices and quantities, and things get renegotiated not on every single transaction. So you have, sort of semi-spot freight that makes up a non-trivial fraction of stuff that moves.
Yeah, I think if you flipped it to brokers, I don't have the number in front of me, but conventional wisdom is 80% of their freight is going to be spot from the shipper. Only the largest brokers, by and large, there's two populations of brokers by and large that have had success in the contract market. And when I say contract, I mean shipper to broker contract. It is large brokers, large stable brokers, able to handle large chunks of business. Very few shippers are going to write a contract to handle 10, 20, 30, 40 loads a year. And then you have like niche brokers that serve a specific equipment type or a specific lane where they may contract on with a shipper to haul, that kind of stuff. But by and large, the overwhelming majority of that freight, especially right now, is going to move spot between the broker and the shipper. And again, in any environment, you might have some handshake agreements, but I think in our data last I pulled, it was like 97% of broker to carrier transactions were all spot. Very, very few of those have actual paper contracts. I don't care who you are, big brokers, small brokers, niche brokers. The only real exception there is mixed fleets, which have asset and non-asset division. They may be kicking some of that freight over to feed backhauls into their asset side. But even that, what do you consider that? I mean, is that a spot or a contract load?
We have two quick questions, I think, and then we can wrap. Destiny Steel, I missed the end of when you spoke about repetitive loads being posted. How are you guys handling that? The answer is in the load to truck ratio numbers, we don't. In the MCI numbers, we turn down the volume. I can't go into too deep of the details about this, but essentially, if you are posting aggressively, if you're making the same load multiple times, each subsequent post is counting for less and less of a full post.
And this is only on the analytics side. We can kind of table this question and maybe bring Sarita on or someone to talk about how it's actually handled on the actual load board itself. Because we're not talking about load board governance or policies or what's in and out of bounds. We're not talking about any of that. This is just like if you just go in the hot market maps or you buy the load to truck ratio from us on Snowflake or FTP and you buy MCI, you're going to notice that it's a little bit different. And we're trying to explain how those are different, why those are different.
Yep. Giuliano, what are some good lanes for a carrier based in North Carolina?
Yeah, I've got some. I just pulled up some data, Ned, on our rate map dashboard. Over 150 miles, Roanoke, Virginia, Richmond, Columbia, South Carolina, at 414, 486, and 380 a mile respectively. Highest round trip rates, again, Norfolk, Richmond, Roanoke, Charlotte, are all paying really good rates this week in RateView. Mostly shorter haul, though, I would say. East loads west are paying much less.
Yeah.
Go north.
Go north. Maybe not with this weather right now. All right. So with that, I'm going to wrap us up. Dean, where are you going to be? Sights and sounds of Dean Croak over the next week.
Landline Now tomorrow night, 7 p.m. Eastern on Sirius Road Dog Channel 146 this week.
Cool. So as I mentioned, we'll be recording Freight Find later today. That'll come out before the end of the year. You can check out Dean's update on dat.com/market update. Any of our past YouTube videos are cataloged on our YouTube section there, our account. And with that, we will see you next week at 10 a.m. Eastern on Tuesday, and we hope you have a great rest of your week. Goodbye, everyone.
Bye.